You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back to the Learn Like a CPA show. Today we're going to talk about the health savings account. Let me preface this by saying Congress was drunk when they wrote this part of the code. And the reason being is it is triple tax advantaged, unlike other forms of retirement or savings accounts. According to a study done by Fidelity in 2021, a 65-year-old opposite gender couple retiring can expect to spend $300,000 in health care and medical expenses throughout their retirement. For single retirees, the 2021 estimate is $157,000 for women and $143,000 for men. However, a study done by NerdWallet also shows that the average/median 401k balance for people ages 60 to 69, the average 401k balance is $195,500, and the median 401k balance is $62,000. The differences between average and median are that the average is pretty much you sum up the total amount of money divided by the number of people in that scenario. The median is taking them, listing them smallest to largest, and picking out whichever one is in the middle. So the median is a much better representation of what's going on overall compared to the average, and that's why we should be looking at the median number instead of the average. And the median number being $62,000 in a 401k compared to the average amount of medical expenses spent of $157,000 for a woman or $143,000 for a man, we can tell that America is severely underfunded, and most Americans don't have enough to afford the health care costs that are going to come with retirement, let alone living expenses, utilities, mortgage, you name it. If they can't cover their health care costs through a 401k, they're not going to have much money for anything else. So as you can see, this is a huge problem in America, and we have to do something about it and insert the health savings account. So the health savings account is a tax-deductible and tax-free account that allows you to pay for various medical expenses such as co-pays, deductibles, dental, acupuncture, massage therapy, prescription drugs, and drug rehab. For a complete list of eligible expenses, you can visit IRS publication 969. The HSA operates like a normal retirement account in the sense that you can invest the HSA contributions into the stock market. So who qualifies? You can have an HSA plan that is sponsored by your employer. You can have an HSA plan even if your employer doesn't allow it, so maybe you set it up on your own. You can have an HSA plan if you're self-employed. The biggest caveat with the HSA plan is that you have to have a high deductible health insurance plan in order to contribute. You cannot have a PPO or like a fancy silver top-of-the-line health insurance plan. So some of the pros. The biggest pro is you get a front page tax deduction on your return regardless of your income level. So if you're familiar with traditional and Roth IRA accounts, those pretty much go away if you make a certain amount of money. You're not able to contribute to those. However, the HSA doesn't have any income limit, so you could be making $1 million and still contribute to an HSA account, unlike the other IRA accounts. The contribution limits are $3,650 for single individuals and $7,300 for a family plan. So if you are married in a 22% tax bracket, that contribution is tax deductible and it's worth $1,600. If you're in a 37% tax bracket, that contribution is tax deductible and it's worth $2,700. So right away, you're going to get a tax break for contributing to the HSA. And we talked about you can invest the money however you want. So you can pick the same sort of stocks, mutual funds, index funds that you would invest in a 401k or an IRA. You can do that with an HSA. It comes out tax-free for any medical expense for the rest of your life. Any qualified medical expense, that it's going to come out tax-free for the rest of your life. So the earnings on that account are going to come out tax-free. You can also self-direct your HSA. You can own crypto, you can own real estate, you can own land, you can own businesses. Mark Kohler actually owns cows through his HSA account, which is pretty cool. And the last thing is it is triple tax advantage, which I like to talk about. And I have a whiteboard kind of show you guys the breakdown. So in order to understand why the HSA is so much favorable than, say, a traditional or a Roth IRA, is you have to learn the differences between all of them. So if we start with the traditional IRA, you're getting a tax break when you contribute the money, as well as when the money is earning and growing. However, when you go to pull the money out, this is where you're going to be paying taxes, right? When you go to withdraw. The Roth IRA, however, in the Roth IRA, you pay taxes when you put it in. So this is where we're paying taxes here, right? But it's going to earn and grow tax-free. And when you pull the money out, it's going to be tax-free, right? So these have double tax advantage in these accounts. However, the HSA operates in a way that you get the best of both worlds. You get a tax deduction when you put the money in. It's going to earn and grow tax-free here. It's tax deferred. And when you pull the money out, assuming you pull it out for qualified medical expenses, it's also going to come out tax-free for qualified medical, right? So triple tax advantage, unlike the traditional IRA and unlike the Roth IRA, there's 3 advantages there for tax purposes. So some of the cons of the HSA, the cons are, again, you have to have a high deductible health insurance plan in order to contribute. So for those who are maybe they're early in their career, single, or maybe just married, starting to have kids, if you do not have a built-up emergency fund, that's going to be I would say your 6 to 9 months. Plus, you might want to have your health insurance deductible stashed away on the side, because some of these plans, a high deductible health insurance plan, you might have a $3,000, $4,000, $5,000 deductible. You're going to want to make sure that you have your emergency fund plus that deductible stashed away if you're going to contribute to an HSA, because the worst thing that could happen is if you start contributing to an HSA and you don't have an emergency fund and you don't have money set aside, when you have a big accident, you're going to have to go right to that high deductible to cover the cost of the medical expense. So you're going to really want to look into your financial situation to see if you're going to be able to afford the HSA account. And this is going to be dependent, again, on your situation, your family, kids. If you take out the money for anything other than medical expenses, it's going to become taxable income, just like a traditional IRA would. If you are 65 or older, you can no longer fund an HSA account. And lastly, you cannot pay for over-the-counter drugs out of an HSA. Again, you could reference that IRS publication about what exactly you can and can't buy out of an HSA that's qualified, but over-the-counter drugs, you're not able to pay out of the HSA. So one of the advanced strategies that I don't see too many people talk about out of the HSA is this idea of using it as a tax-free piggy bank, because you're able to, if you pay the expenses out of your own pocket and not using the HSA debit card that they give you, you're able to stash away the receipts for a later time, and you're actually able to cut yourself a check tax-free from your HSA account to your personal account at a later time. So as long as you have record of those receipts. And so what this kind of looks like is, let's say I have my HSA account for 5 years. And so here's 1, 2, 3, 4, 5. And let's say I contribute $2,000 a year, right? $2,000. And every single year I might have $1,000 worth of medical expenses. Well, instead of paying for these expenses out of the HSA account, I pay them out of my own pocket, and I keep the receipt. I'm able to cut myself a check at a later time for the total amount of medical expenses that I had. And the reason why this is applicable is time value of money, because we do not want, if we're contributing money, we don't want to take it out of that HSA account right away, because time value of money, we haven't given it enough time to earn and grow. But also this is a tax advantage account. So we want to, our money is going to grow tax-free. We want to keep it in there as long as possible, so that way we can take advantage of that compound growth in a tax advantage account. If we're just contributing money and then pulling it out right away, we're not actually taking advantage of that. And the government will give you every single reason under the sun to pull money out of these accounts, IRAs, 401ks, HSAs. Once that money is in there and it's earning and growing tax-free, we want to make sure that we don't take it out. But in this scenario, if you had $5,000 of medical expenses over this entire time, after the 5th year, you can cut yourself a check for $5,000. And so it operates in a sense that it could be an extra emergency fund. It can be, like I said, I like to call it a tax-free piggy bank. You're taking advantage of compound interest, time value of money. One of the questions that I received about the HSA account before I made the podcast today was, how should I prioritize funding my 401k, my HSA, and my Roth IRA? And I'll just preface this by saying, assuming you have enough disposable income and you meet all the requirements to contribute to these accounts, this is how I would fund it. So first off, I would contribute up to the 401k employer match because it's free money, right? So that's a guaranteed rate of return because your company is going to match your contributions. You're not going to get that in an HSA. You're not going to get that in a Roth IRA. 401k employer match, guaranteed return. The only time I wouldn't do that is, let's say maybe your 401k plan has really crappy investment options, or maybe their match is crappy too. But 401k up to the employer match, because that's guaranteed money. Then I would go fund your HSA before your Roth, because in my opinion, the HSA, you're not going to have to worry about income limits to contribute. You're going to be able to get a tax deduction for it, whereas the Roth IRA, you're not getting any tax deduction for your Roth up front. It earns a gross tax-free. So 401k up to the employer match. Then I would hammer out your HSA. Then if you have disposable income money left over, that's when I would contribute to your Roth IRA. So we talked about so many things on the show today. We broke down the need for the HSA, about how America just doesn't have enough money saved for, let alone medical costs, but also for regular utilities, mortgage payments, cost of living, right? So there's a huge need for the HSA account. We broke down the HSA account, the pros and cons, kind of how it operates, what you do's and don'ts. We broke down different types of strategies that we can use with the HSA account. And then we talked about the order of operations when it comes to contributing to an HSA account. If you enjoyed the show, please make sure you leave a review on either Apple or Spotify. And let me know what you want to see in the next podcast. You can message me on Instagram or Twitter at LearnLikeACPA. Thanks again, and I'll see you in the next episode.